Hi guys, welcome back. So let's first take a look at the market this week, and then we'll go over the HSI, the Chinese stocks, and give out some opportunities to watch out for when the market is dipping further. So the S&P has been dipping 4 days consecutively with no hope. It's looking very bearish. But since January, every time we dip 4 days in a row, there's a pattern that after 4 days, there would be some rebound, whether it's big or small. Let's see if it remains the same this time. But overall, my view on the market in general for this correction is still pretty bearish. And the target for this correction is still remain the same since the beginning of January, to be 3850. So if it does dip to this level, I think we need to counter our fear and start buying the dip heavily. So this target remains the same whether we have some rebound here and there. I'm not sure. At first I thought we would have some rebound this week before dipping further, but the more it goes, the more I'm losing hope. So as I posted yesterday in the Discord, the plan for this week was really to take opportunity of rebound to build up the short position and gold, because right now gold is acting as a hedge against the stock market and where the money would go to during war when everyone is fearful, right? So I recommended UVXY and TZA for this week because I am still overall bearish on the market, and GDXU again for gold because again for this year 2022 I am still bullish in gold for the medium to long term. And actually silver is a bit better than gold even, but only if you have the holding power, because gold has been up by quite a bit since the day I pointed out the breakout mid-February. It's been up almost every day non-stop. And the ETF, the triple leverage gold ETF I recommended, has been up since a low of 10.3 all the way to this morning almost 20. So almost double. So obviously if you buy right now, it would be taking a risk, taking a chance that it might pull back or come down pretty hard. But if you have the holding power, I still think that 2022 is the year for gold and silver. Not only because it is the place to go to for the smart money or fearful money during war, but even after war, it is a good hedge against inflation. In my belief, gold, every time the Fed does unlimited QE, like last time during the financial crisis, every time there is this crazy QE, gold would rise quite a lot as a hedge against inflation to preserve the money value. And last time in 2020, here, it was starting the QE and gold started to rise, but it did a false breakout and come back down. I think it has some coincidence to do with the fact that Bitcoin was reducing the reward by half. So Bitcoin had the bull market at the same time that gold should rise. So it took away a lot of the attention from gold to hedge against inflation. But now Bitcoin is entering a kind of bear cycle. So that's why I think right now it is the opportunity for gold to rise back to where it should be back in 2020, 2 years ago. Because instead of breaking out, it spent almost 2 years doing consolidation. And this long consolidation would be a setup for a strong breakout. So I think gold is not finished rising. It's by far not over yet. But I do think it might pull back anytime and create the opportunity to jump back in. But if you have holding power and you don't care about the volatility up and down, then you can buy anytime. Now let's talk about the HSI. Wow, what a fall. That is really beyond everybody's imagination, because everyone thought it would not break the December low. But not only it broke December low, it also broke the COVID crash low. That is looking pretty bad, right? But remember, we talked about that. If it really broke this low, it is heading into a golden opportunity that only happens once in 30 years. Yes, before I would call that once in a 10 years opportunity back in December. But right now it's been upgraded to the once in 30 years opportunity officially. But with that said, it doesn't mean you need to go all in at once because you don't know where the bottom is, obviously. And this process, it's painful to see it dipping the fastest, one of the fastest in history, just like back in the financial crisis. Now let's look at the quarter chart. You can first take a look at this blue trend line. It's the 60 EMA moving average. So after the financial crisis, every heavy correction HSI had, maximum it dipped to the blue trend line. It happened in 2012, again in the Shanghai Composite or A-share stock market crash in 2015-16, and then again in COVID crash. So every time this blue trend line was supported, but this time it's broken. So next we would be looking at this target, the green trend line that happened to dip there during the financial crisis in 2008 and the dot-com bubble between the blue and the red. So that means a possible target is 19,062, which looks pretty scary, right? And yet it is not surprising. So something to remind you is that right now the HSI has dipped lower than the COVID crash low. So we need to watch out for the stocks individually because they might also reach the low of COVID crash if they haven't yet. Now let's go back to the daily chart. Now if we look at the bull market since the low of after the financial crisis, it had rise from 10,000 points to all the way 33,000 back in 2018. So it was almost a 10 years bull market. And the HSI had more than triple. And since we just broke the low of COVID crash here, so we can see this wave as a three-wave correction. 1, 2, and 3. Because 3 needs to be lower than 1. So only that it had broken the low of COVID crash, then we can consider this a three-wave correction. So this makes this part a 10 years wave 1, and after the big wave 1 of rising, there is the big wave 2 of pullback, and after that we're gonna have a big wave 3 of the rising. That probably would last for the next 10 years. And in this case, that means we might have a similar segment for the first wave from 2018 to the bottom of COVID crash, dropping 37%. So we use that and measure the fall from the peak of last year in February. To drop 30% from 31,000, we get the target of 19,500. So around 19,500 points would be the target if this is really the big 2-wave pullback and 3 small wave segments. Now let's try to use the golden section to mark from the low of financial crisis to the peak of 2018 33484. Then we get a few important numbers, which is the 61% to be 247, which happened to mark the peak of the recent rebound around 25,000. And then the next number, 50%, to be 22,000. This is a normal pullback distance for second wave, but this time we have just dipped below it, the 22,000 level. So that would give us the next target of 38.2%, which is at the level of 19,400. Well, in every single way of measure with the moving average, with the wave measurement, and with this golden section, we get similar results as around 193 to 195. With the 3 methods we just tried, we got the same result. So this number, definitely mark it down. Very important to remember. And then, interestingly, I just saw this article from the Morgan Stanley that says Hong Kong stocks are the saddest this year at 19,500. So Morgan Stanley just released a report and lowered the forecast for the lower limit of Hang Seng Index this year by 7.1% from the previous 21,000 points to the low of 19,500. So again, I don't know how they calculated, probably similar way as what I just did, but different methods got into similar results, which all points towards 19,500. So I guess it is a good opportunity, but there is no rush. In fact, you can average down, maybe slowly take advantage of the dip and then trim at rebound to lower the cost and then try to grab it at lower price again. Because even though the target is this, it doesn't mean it just goes steep like a cliff, right? Well, it was like that for COVID crash because of Black Swan news. But it's this time the same thing with the war and oil price? Maybe. I don't know. We'll see. I don't know if it would really get there, but I do know that if it gets there, I would take the opportunity to add heavily the Chinese stocks. Now let's talk about the watch list, the opportunities. First, Baby Neo. So we know that it's going to start trading in March in the Hong Kong index, and it would be likely included next time in the Hang Seng Tech Index, just like Xiaopeng and Li Auto. But even with this news, it's not enough to boost the share price because it's been a downtrend for a while. It's very hard to counter the trend. It's easier to follow the trend and buy put option, but I guess if you don't want to short Neo, you can wait for the opportunity to buy the dip. And for now, my target towards Neo has moved to the range between 15.5 to 14.8. So my target for Baby Neo has moved to the range of 15.5 to 14.8. So it might happen within this correction. And I would watch out for this opportunity to add the dip. EH, oh, that's tough. Because my last support for EH was the low of today, actually, around 10.9. So if it breaks the low of today, then the next target we would be looking at the historical low, between 7 to 9. Pretty scary, huh? But what can't happen these days, right? Everything can happen. And then I would also be watching out for PDD. Last time I said that 44 was a good support, but if it's broken, then the next target is around 36. And today we got to the low of 37. Yesterday I couldn't take it anymore and added the dip at 38 already. So if it doesn't stop here, the next support we would be looking at this range around $30. It looks scary, but if the market really dip or crash further down hard, then I think it's not impossible. But if it gets to 30, I would be adding shares and call option and leaps. Next, let's take a look at Xiaopeng. My next target was 22 to 25. And today when it dipped to 25, I already couldn't resist and added some shares. But if it breaks 25, I would wait for 22. JKS is super strong. Last time when the war was official, it had jumped from the low of 35 to the high of today, which is 56. So up and down 58%. Quite a jump, huh? Because of oil crisis, it would make alternative energy extra important. So it was making a strong breakout with volume to follow too. So right now, if it can backtest this trend line around 46, it might be an opportunity again. Next is the consolidating range around 37 to 39, but I don't know if it would get back to this level though. Right now, the breakout seems pretty strong. Also, let's not forget the famous Alibaba, who had been constantly dipping without any hope, any end. I see that it broke the level of 100, which is quite an important psychological standpoint. So it had opened up more room to drop. Next, support to add if 95 cannot hold, because 95 is a small support, but if it doesn't hold, then next you would be looking at this range between 85 to 87. Was the top of the double bottom back in 2015. So I think there is a good chance this support can hold. So if it does get to 85 to 87, watch out for the dip. Right now, Alibaba is falling very hard, but I think it's showing some hope there because the fall has been speeded up faster and faster. So this usually is a bottom signal, means near the end. Usually when it's towards the end, it would speed up. So if you are interested in buying CWEB, wait for Alibaba to get to 85 to 87. Next is FUTU. Haven't mentioned this for a while. It has constantly dipping. But it doesn't affect that this company is still a good company. It's just experiencing some short-term difficulty. fundamental-wise and share price-wise. Well, the share price is reflecting the company's fundamental, right? Whether it's external factor, which is the regulation, or internal factor that they are firing people, reducing costs, and so on. But right now, the PE has gotten to be 12, much more fair than a year ago. The previous support at around 36 was quite important and recently has been broken. So now we would be aiming for the next support, and it is around 28, 27 to 28, okay? If it dips there, I think I would add some shares myself too. Next, let's talk about two small caps. First, there is YSG. There's no sign of bottom right now, but there's one good news, which is the fact that Hill House Capital had added back their position on YSG in Q4. So they are the reason why I was interested in YSG in the first place. So it's definitely good to see that they have added back on, joining the board again for YSG. I read that the leader of Hill House Capital has relationship with the founder of YSG, so I guess he had done the DD for us to know whether he is a good leader and this company has good management team or not. So that's why yesterday I said I went back to YSG, bought 10,000 shares at 1.09, and today, for no reason, it has gone up 17%, at some point near 20%. No reason. Maybe because the earning is coming up on Thursday morning. But I kind of don't want to do an earning bet right now. So I would set a profit limit and see if I get stopped out to take profit. But in a long term, I think right now, the PB ratio is below 1, definitely grabbing a deal here, and the company has or should have good amount of cash. Last time we checked through the earning call, and the market cap had fallen below 1 billion. And in the last earning call, it seemed like they were making much less loss. So we might be breaking even somewhere between this year or next year, hopefully. Maybe I'm too optimistic. But I think the reason why it fell so hard is not only because the crash of Chinese stocks, but also because usually after the unlimited QE, the inflation would become a problem, and this would make it harder for Chinese brands, the domestic brands, because they don't have pricing power. They have thinner margin than the foreign brands to begin with. That's why I think 2021 and 2022 would be the most difficult years for Chinese domestic brands, consumer brands, but starting from next year, I think it would be better for them. So it depends if you want to get in early, and depends if you believe in this management team or not. Last, let's talk about the most risky one, which is DIDI. I've been watching out DIDI for a while, ever since they announced to be delisted and get relisted in Hong Kong. We still don't know the way yet, and I still think it might most likely be like Tencent and Meituan to remain listed in OTC, so a lot of the international investors' share would be swapped. For now, the share price has no bottom signal yet, but if it can make a new low, so breaking the low of 3.33, it would be better because it would be making an MACD divergence, and that technically would need a follow-up rebound. And right now, the PB ratio is also less than 1 to be 0.96 after today's fall of 11%. So the share price is looking more attractive, a lot more than the IPO price, which was 14 and the high of 18. I remember before the IPO, I made a video about DIDI, and I said I was not a fan of DIDI and I did not plan to buy it on the IPO. I know a lot of people did, but I said the water is too deep and is still overvalued even though they lowered the IPO price. So right now that the PB ratio is less than 1, I guess if you want to have a speculative position that is small and for gambling, you can try if it makes a new low. Okay, now that's a lot of stocks shared in one video. Maybe too much information. Now, if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.